Okay. I think we are live now. Good afternoon. This is CFA Institute Research Challenge in Switzerland 2021 final event. Warm welcome to our participants and to our online audience. CFA Society Switzerland members and volunteers, professors, assistants, our sponsors and partners, our subject company, Temenos, and everyone else who is here to support students. Today's event is organized by CFA Society Switzerland University Relations team with two our dedicated volunteers, Florian Esterer, who organized the first research challenge here in Switzerland 12 years ago and is still very active, and the chair of the University Relations Committee, Olivier Müller. My name is Mirjana Beutel. I'm from the CFA Society Switzerland, and I would like to thank our colleague Joshua Paris for organizing the meeting for us today. CFA Institute Research Challenge is a global annual equity research competition that provides participating students with intensive training in financial analysis. Students work in groups and assume the role of financial analysts, and they are judged on their ability to value stock, write a research report, and present their recommendations. Every year, more than 1,100 universities participate in the research challenge with more than 5,700 students. And on the left, you can see how the global winner was celebrated back in 2019 when in-person meetings were possible. And on the right, you can see how research challenges look like today. This photo was taken after the University of Lausanne was named one of two winners of the EMEA regional final last year. Yesterday, we had a very intensive afternoon, semi-final rounds. We had 11 universities participating, and all of them had an excellent presentations. Today, we have 6 universities with us, and we're going to select a university that will represent CFA Society Switzerland at the EMEA regional competitions in March and April. And for the very first time, we are going to announce the second and the third place. So today with us are University of Zurich, University of Geneva, University of Lausanne, University of Bern, University of St. Gallen, and University of Lugano. Welcome. And I would like to welcome our experienced judges now, Markus Matuszek, Rahul Sengupta, Peter Romansina, Christoph Gretler, Florian Ester, and Olivier Müller. Thank you very much for supporting us all these years. And here you can see the schedule for today. We will start with presentations at 14:15, and we will make a short break after the third presentation. After the last presentation, we will make a little longer break, and we will be back at 7 o'clock with the award ceremony. We are very excited to host 2 keynote speakers today, Marisa Drew, Chief Sustainability Officer and Global Head Sustainability Strategy, Advisory and Finance from Credit Suisse, and Monica Rancati, Chief Human Resources Officer from Temenos. For our online audience, please note that there will be a few minutes break between each presentation. Competition rules are very simple. There is 10 minutes for presentation and 10 minutes for Q&A. After that, we will allow a few minutes so the judges can complete their score sheets. And now, without any further ado, we will start preparing for the first presentation that will be given by University of Geneva. We will be back at 14:50. Okay, so we are back. It is my pleasure to welcome the first team presenting today, Rim, Claudia, and Emilia from University of Geneva. So, students, you can unmute yourself. All good. Would you like to upload your slides now?
Sure. Can everybody see my screen?
Yes.
Perfect.
Okay, so after 9 minutes, I'm going to wave. And minute after that, I will stop your presentation in case you are not finished. And after that, we will have Q&A with judges. We are ready when you are. Good luck.
Thank you. All right. Good afternoon, everyone. We are pleased to represent the University of Geneva, and today my teammates and I will present you with our investment recommendation for Temenos AG, for which we issue a buy recommendation. The backbone of our analysis lies in the following argumentation. We expect the solid SaaS-driven financial position that Temenos shows to hold, with revenues growing strongly thanks to unique competitive positioning and forward-looking market expansion, all of this being backed by improving ESG scores. The financial analysis that we will further present you with gave us a 12-month target price of 141.9 Swiss francs, granting an upside of 19% from the valuation date price at 119.6 Swiss franc.
Temenos has entered various markets, both geographically and in terms of clients. We see a clear focus on Tier 1 and Tier 2 clients. Though currently the majority of their banking clientele lies in Europe, there is a clear strategy to dominate the United States, which has proven to be vastly underpenetrated, justifying Temenos' new focus expanding in the USA. This new goal translates to a wish to take advantage of a growing need in an underdeveloped industry through the right partnership at the right time. The United States has the largest number of fintech players, and fintech industry grows over 9% each year. US banks need to digitize to survive, and the US market is set to potentially provide an increase of 38% on annual revenues. Temenos has struggled to enter the USA since 2013, but we believe that the Kony acquisition in 2019 flips the dynamic around. Kony not only enhances the current Temenos Infinity product line by combining Kony digital banking experience and multi-development platforms, but also gives Temenos the client base to successfully introduce Temenos Transact. Temenos manages to maximize the effects of both R&D and M&A to generate combined growth opportunities and nurture client loyalty over time and through technological revolutions.
Seeing a mixed formula of R&D and M&A could pose issues of contradictory strategies. But in the case of Temenos, the two processes complement each other quite well. Both have the same goal of ensuring fast market domination through the mastery of technological and technical advancements and the constant renewal of the product set to fit the newest criteria. M&A is tasked with bringing accelerated forms of what R&D might bring out, without giving up on R&D so that they become trendsetters themselves. The combined effect of R&D and M&A allows Temenos to be specialized in the software banking industry, starting with a competitive and robust one-size-fits-all solution with regards to bank size and clientele, while allowing each client to customize the product to its own internal devices and platforms. This grants current client satisfaction and a certain sense of belonging to a highly technical and state-of-the-art community, and sets the tone in the market for potential new clients to be attracted, while also being a deterrent for competitors. The SaaS transition poses an opportunity set, and the threat of cannibalization between the SaaS and the licensing product lines is somewhat offset by growing total market. In the case of Temenos, computing the EBITDA margin bridge allows to show that the switch in revenue allocation, meaning the increase of recurring revenue, is the major driver of the increase in the EBITDA between the two boundaries of our analysis period. Computing the EBIT margin, we see the net shock of the 2020 pandemic, which we forecast to be recovered fully at pre-COVID levels by 2025, which is backed by many external research nudging towards the 3 to 5 year long recovery for industries that didn't suffer directly from COVID, such as tourism. Essentially, we expect slower growth until 2023 and then back at full horsepower. The profit margin follows the same trend as the EBIT margin levels, with a dip in 2020 and a relatively slow recovery, but strong levels reached at the end of the forecasted period. The lowest point being at 19% expected in 2020, going back up to 32% in 2025, which is an increase of 7% in comparison with the pre-COVID levels. The slight smile we observe in the profit margin curve makes sense regardless of the 2020 crisis. In reality, the SaaS transition pushes immediate short-term returns to drastically slow down before gaining new highs after a few years, as the structural changes forces the growth upside to be delayed. Our forecasts portray a more rapid growth in revenues than in the costs, further explaining our growing profit margins by the end of our analysis period. This growth in total revenue is a good balance between organic and inorganic growth, as portrayed by the strategies that we spoke about earlier.
Our DCF analysis is based on the discounting of the free cash flow to the firm using a WACC of 5.19%, which we computed with a 10.95% cost of equity derived with KPM and a 4.5% cost of debt derived from interest over interest-bearing debt. The market is growing and it has an intrinsic growth level of 15% and a terminal growth of 3.9% based on long-term expected inflation and long-term expectation of growth for the GDP in the areas in which Temenos does business, such as regions in advanced economies. Two other valuation methods have been taken into consideration, and they are dividend discount model and multiples valuation. The dividend discount model is relevant in Temenos' case, as it has been paying dividends in a steady manner since 2013. This dividend paying trend is expected to continue and to see dividends grow, at least with the same capacity as seen in the past, meaning at least doubling every 5 years. For the multiple valuation, we have decided to stick with the same peer group as we have used for financial and strategic comparison, which shows similar price and EPS profiles, allowing to come up with expected P ratio to apply to Temenos EPS to arrive at a target price of 136 Swiss francs. We have chosen the P ratio as it is the most consistent to express growth potential within the market, which is one of our arguments for our recommendation. Aggregating all the three prices, we decide to allocate different weights to each valuation method and its corresponding price, with DCF being the heaviest as it depicts the most accurate picture of what Temenos value will look like, but not dismissing the other two methods, as the software industry is driven by group momentum and Temenos growth is well represented in dividend growth, even though we cannot consider this latter as the method with the perfect fit for our company.
To complete our analysis, we have identified potential risks that Temenos cannot precisely forecast. We observe that the majority of risks are located in the lower portion of the matrix in terms of probability of events. To us, the ones with greatest impact are market-related ones, probably closely followed by the risk of failing at finding the perfect M&A matches to conquer the challenges. On a global scale, Temenos is right above average in terms of ESG scores, though it is noteworthy to mention that there are fulgurant improvements in each section of the score in the past few years, with the highest improvements in social issues. ESG factors today are more and more taken into account across all industries, though still hard to identify with precision and to quantify. This is why we have chosen to use the SASB framework for the software industry to analyze Temenos' ESG score, which gives us 6 precise and industry-specific components to our analysis. From an environmental perspective, we focused on energy management and more specifically on carbon emissions. We can see a clear decrease in CO2 emissions over the last 5 years due to the amount of policies and the green initiatives that were taken with respect to operations. Regarding female inclusivity, Temenos is rather average in their female representation overall and the gender wage pay gap. With a gender pay gap of 17%, Temenos should attempt to reach the US tech industry gender pay gap of 4% as part of the US expansion strategy. As a company working with financial data, data security and customer privacy are major issues that Temenos is facing. The company is compliant with the GDPR regulation and applies this across the majority of operations worldwide. In order to prevent cyber attacks, Temenos uses advanced artificial intelligence tools. In 2019, 11 incidents were reported, though only one was severe, which really demonstrate their ability to scale down the incidents. To sum up, we extend our buy recommendation to you with the justified expectations that revenues and earnings will grow as a result of Temenos' leader position and value-creating strategies. Thank you for your attention. We will be taking your questions now.
Thank you very much. Judges? Would you like to unmute yourself?
First, Judge Christoph.
Hey, thank you, Olivia. Thank you, team, for this great comprehensive presentation, and also well done. I have two questions. One relates to your calculation of the WACC, and the second, relates to the business model of Temenos. First, on the cost of capital, could you explain what kind of capital weights you've been using and what kind of justification you have for those? I noticed you have cost of debt of around 4.5% and cost of equity around 10%, and the WACC is 5%. So you must have a pretty heavy weight towards the debt side. Could you justify that? With maybe some comments on the balance sheet, or and the second question with respect to the business model. I think you mentioned at the beginning, that the company is looking to move to this SaaS model, from a more of a license income model. What do you think, this will have, impact this will have in terms of margins effect, in the medium term? I noticed you basically assume that, there is a hockey stick and margin will go up substantially, but, is this really reflecting this, shift in business model that is going on as well? Thank you.
So about the different values, and so the WACC, which is pretty high, we know, but we have done calculations about the respecting Temenos structure of debt, which is pretty high, with us 81% of debt and 19% of equity. And we derived it with CAPM. And then we used the cost of equity of 10.95 for discounting the free cash flow to the equity of the firm.
Okay, so in practice, we would use higher WACCs actually, for a reference point, and kind of we would use more like market value for the debt, and equity. So basically, if you look at the market cap, is around 10 billion, and they have $1 billion in debt, so we would have a 90% equity ratio, so a different tilt than you have, but you, I think, have understood the theory and kind of applied it correctly with your assumption. Thank you.
I think this was definitely a challenge, because actually in their yearly reports they actually provide some I guess nudges as to what cost of debt and cost of equity to use should analysts want to do that. But we found it to be a bit odd with regards to even, I guess, data providers, the capital structure that they had provided as nudges for us to figure out the 80-20% that we kind of used. So we decided to take the leap and just use our own numbers instead.
Good, well done. It's good to know approach.
As for the forecasts and how they take it into account the margin evolution with regards to the SaaS transition, we actually did our forecast sort of in 3 steps. So the first one is really taking into account exactly what's going on with the transition, which started to happen actually a few years ago, but really was even more so evolutionary in this year because of everything that's going on. So the first step was kind of making expectations for 2020, trying to take into account all of this. We took the interim report and tried to sort of extrapolate from that. And then for the next 3 years, so 2021, 22, 23, we took sort of 20%, 50%, and 75% of what happened this year to kind of, I guess, include as much as we could this latent, delayed evolution of margins. So despite us having actually quite high margins in 2025, we actually delayed as much as we could in that regard.
Good. Thank you. Thank you for your thoughts.
Thank you. Next question, Florian.
So as a follow on this, in the SaaS growth, we have to differentiate between existing licensed clients which switch to a SaaS model upon renewal and new clients who come on as SaaS clients. How have you accounted for that in your margin evolution?
So essentially, if I can take that question, maybe my colleagues can add up on that later on, but essentially, we did take that into account, but not so much quantitatively, and that is kind of a choice that we made, because we're betting on two things here for growing revenues, not only the SaaS transition, bringing better revenues in the midterm to long-term horizon, but also the US expansion, making the market pie a bit bigger, I guess. Because we noticed, we did a little bit of research on the US market for fintech, and we noticed that the 2020 pandemic actually pushed quite a big amount of banks and big banks such as Wells Fargo and JP Morgan to actually digitize as much as they could and reach out for such companies. So we do believe that these two things would offset. And so we didn't go too much into detail and quantitatively speaking about the cannibalization possibility of people transitioning to SaaS from the licensing.
While you're on the topic, sorry, can you sort of show us how your revenue growth stacks up from US versus rest of world and license versus SaaS? So how do these individual components then add up to your revenue growth?
I don't know if my colleagues want to add on that so that I don't speak too much, but I guess in our models we don't have a specific breakdown of US versus European and how it would offset. It was sort of I guess not so much empirical, so I'm not sure we would have models or numbers to show you for that.
Thank you.
Next question.
Can I ask, in terms, there's a lot of talk about the switch from the normal licensing model to SaaS. Why is that important in terms of value for the company? One is you buy, one is you rent. If it's like a car, if you buy the car or lease the car, depending on what you pay for it, the net present value, it doesn't matter. So why the fuss?
We believe that this transition to SaaS is really important if it is combined with the know-how and the ability of Temenos to create strong bonds with its clients. And so we are not afraid that this will impact negatively, and so will provide some changes during the years, and so switching from one company into another, because we believe that Temenos has the right capabilities to maintain the clients, even though they are not buying anymore, but just renting their services.
And is one more valuable than the other? Have you checked with the company if one is more valuable than the other in terms of net present value?
They do include a price increase in their renting product line to demonstrate that. So technically, it wouldn't make so much of a difference, as you said, considering that with the net present value, it would be equivalent if they take into account all the inflation and other factors that would happen with regards to the price. But from a business model perspective, as of right now, from the licensing product lines, only 15% of clients that are in the licensing product line actually get the license again after 10 years. So whereas I'm not sure I have the number in my head again, but for the SaaS ones, it's slightly higher, quite actually significantly higher of rerun year after year. So in terms of long-term revenues, it is more interesting to switch back to the SaaS.
Thank you very much.
If I may jump in here very quickly in terms of valuation. Christoph just asked you about the valuation on the WACC. I'm more interested on the sensitivity of your valuation model, especially regarding the DCF. So did you also run a worst case scenario or a best case scenario? So your number must be somewhere in the middle or somewhere around that. So what are the extremes?
Actually, so we did two types of sensitivity analysis. So we had actually three types of DCF included in our final DCF price. And maybe I can show you this. So essentially we had a blue and gray sky. And then we had also sort of a sensitivity analysis. Sorry?
Thank you very much. It was a great presentation.
Thank you.
So we will allow a few minutes for judges now to complete their sheets.
Thank you very much.
Thanks a lot.
Thanks.
Thank you very much.
Thanks a lot.
And we will be back at 14:45. University of Lugano presents next.
Okay.
So we are back now. Welcome to Simon, Xavier, Nabil, Alessandro, and Irene from University of Lugano. Before we start, may I please ask students to pin my video on top, because after 9 minutes of your presentation, I'm going to wave, so I want to make sure that you can see me, and a minute after that, I will stop your presentation. You can upload your slides now. Yes, we see your slides.
Perfect.
Good. So we are ready when you are. Good luck.
Good afternoon, everyone. We're the University of Lugano, and we're pleased to present you our buy recommendation on Swiss banking software provider Temenos. Have you ever thought of what's going behind the scenes when you want to open a bank account or make a transaction? When you access your bank through, let's say, your smartphone, your device is getting connected to the digital front office of the bank through an application layer. But what is that? Well, it's a storefront of the bank in order to acquire customers, market for them, and provide them with services. The digital front office software then communicates with the core banking software. This is the heart and engine of the bank. It is where transactions are processed and bank accounts are stored. Temenos' core banking product is called Transact and is their largest product with around 2/3 of the product revenue. Second in line is their customer-facing product called Infinity with around 20% of sales, and the rest is attributable to payments, fund administration, and wealth management. Temenos is founded and based in Geneva, Switzerland. It carries its market-leading position from the fact that 41 out of 50 top banks use Temenos. EMEA is the largest market in terms of revenue generation, followed by the Americas and the APAC. Now, we issue a buy recommendation on Temenos with a target price of 139 Swiss francs, implying an upside of 28%. Our buy recommendation rests on three main pillars: a sustainable and growing end markets, a strong competitive position, and an acceleration in the transformation to SaaS subscriptions. Alessandro, could you please tell us about the outlook on the end markets?
Sure, Nabil. We are living in a world which is becoming more and more digital, where every single industry must adapt. In fact, COVID-19 further accelerated this process, leading to 2 years of digital transformation in just 2 months, according to Microsoft CEO Satya Nadella. In addition to the digital transformation in a broader sense, we see increasing regulation and tough market competition. In this backdrop, we are confident that banks will continue to increase their spending on technology and digitalization, resulting in a 4% CAGR until 2023. Furthermore, banks have the option to develop in-house their IT infrastructure, as they historically have, or to outsource their system to a third-party software vendor, for example, Temenos. It is becoming apparent that outsourcing is the superior choice. Our analysis suggests that banks which are running on a third-party software have a lower cost-to-income ratio and a higher return on equity. Hence, we forecast the share of third-party players to expand from roughly 20% today to 40% in the long term. That means that third-party spending, which is Temenos' market, will grow even faster than bank IT spending in general, putting the total growth rate to around 7% in the next years. Additionally, from an environmental point of view, software is one of the best industries to invest in, as they produce comparatively low greenhouse gas emission and have low resource use. Moreover, Temenos is a front runner within the industry, as illustrated by sustainable initiatives and leading scores from third parties. In other words, Temenos is operating in an industry with a sustainable and structural growth. But Xavier, will Temenos take advantage of this?
Yes, Temenos will, Alessandro, thanks to its strong competitive positioning. Taking a look at the third-party bank IT spending market, Temenos has today a market share of 7% in a very fragmented industry. We expect this to go up to 9% by 2024 at the cost of core incumbents. This is due to 3 factors which set Temenos apart from its competitors. First, its sole focus on financial institutions, in contrary to many of its competitors whose core activity is not banking software. Second, their product positioning, where Temenos is offering a fully packaged and upgradable software on a continuous basis, again, in contrast to other players. And third, innovation as the key pillar in Temenos' corporate strategy. Temenos' approach to innovation deserves time on its own. In fact, Temenos innovates in 3 different ways. First, by allocating over 20% of revenues on R&D, which means outspending its peers by twice. Second, by investing in its workforce and in the community. Temenos' corporate social responsibility is illustrated in its exceptional social score and is a key advantage for Temenos to attract and retain top talent. And third, an active and selective M&A strategy, which expands its geographical presence and obtains new technologies. Just investing is, however, not enough. It must be done in a profitable way. This is exactly what Temenos has done, as illustrated by high returns on capital employed. The result is high barriers to entry and a moat built on its technological advantage. In fact, we see a victorious cycle where Temenos is accelerating away from its traditional competitors. One of the areas where Temenos invested at an early stage was cloud and SaaS capabilities. Irene, could you tell us more about the transition into SaaS?
Yes, with pleasure, Xavier. And as you indicated, the last argument of our investment thesis is the acceleration in the SaaS transition. To get a better understanding, we need to explain how Temenos is selling its software. It can either be sold as a 10-year license fee with compulsory maintenance, or as a 3 to 5 year SaaS subscription. Both SaaS and maintenance are considered stable and recurring revenue in nature, in sharp contrast to license sales, which can be rather volatile. We are now seeing an acceleration in the transition from license to SaaS. We expect SaaS revenues to show a 32% CAGR in the next years, which will drive the share of Temenos recurring revenues to 60% in 2024. A higher share of recurring revenues means more visibility and less volatility, meaning that Temenos will be a more resilient business, motivating a higher multiple and a lower discount rate. Hence, we believe that the SaaS transition will definitely create value for the shareholders. Simon, could you let us know how our investment thesis plays out in terms of forecasts and valuation?
Absolutely. Thanks, Irene. Starting with the top line, we expect revenues to show an 11% CAGR, explained by the market tailwinds and an increasing market share. We also expect continued margin expansion. However, after record profitability in 2020, at the back of massive cost reduction due to the global pandemic, we expect some headwinds in the next 2 years as costs come back online. From there on, we forecast margin expansion driven by operating leverage and motivated by relatively fixed G&A. Finally, we expect strong free cash flow generation to be driven by tighter working capital and to be achieved by lowering days sales outstanding. This leads us to forecast a 12% free cash flow CAGR until 2024. We're now ready to put our investment thesis and forecasts into evaluation of the firm, where we believe Temenos is undervalued based on a combination of a 3-stage DCF and multiples valuation. We see 28% upside to a target price of 139 Swiss francs. The valuation is based more on the DCF model, which weights 2/3 and less on the multiples. This is due to the lack of listed pure play competitors. We used a 6% discount rate calculated using the weighted average cost of capital with a cost of debt of 2.2% and a cost of equity of 6.5%, derived thanks to the CAPM model. For the relative valuation, we used a forward-looking EV to EBITDA multiple and compared Temenos to 2 different groups, banking software companies and other software companies. We note that Temenos currently is undervalued against both the peer groups compared to the 5-year average. We do not think that is motivated given the prospects for continued profitable growth and an increasing share of high quality recurring revenues. So as you now understand, we believe Temenos is a great investment, but all investments do have risks, don't they, Irene?
Of course. We want to highlight that misallocations of the R&D budget, a rough SaaS transition, and the health of the banking sector are all risks that would impact Temenos. In particular, the health of the banking sector should be continuously monitored, as we see significant correlation between the stock performance of the European bank sector and Temenos license sales. This is worrisome in the short term, as banks push their investments forward due to the global pandemic. However, we expect the secular growth drivers to outweigh this risk in the longer term. To summarize, we issue a buy recommendation on Temenos due to its sustainably growing end market, its strong competitive positioning, and the acceleration of the SaaS transition. Thank you for taking your time and listening to our presentation. We are now happy to answer any questions you may have.
Thank you very much.
First question comes from Christoph.
Thank you, Olivier. Thank you, team, for this very enthusiastic presentation. I have 2 questions for you. First, did you look whether the company capitalizes R&D?
Yes, we have looked at that, and they're capitalizing 20% of the R&D.
basically, I saw that you're using, EV/EBITDA as a multiple in your peer comparison. Did you also look at, the other companies, whether they follow similar, accounting rules? And if not, or if so, what would you think about, the impact, it has on your relative valuation, methodology used?
Thank you for your question. Simon, please go to multiples 3.7. So we used EV to EBITDA because we believe that among all the other possible multiples to employ here, this is the one giving the clearest picture of the financial performance of Temenos. In particular, we consider enterprise value in order to account for the different leverage and capital structure of all the companies we have compared to Temenos in our analysis. And EBITDA has been considered because we wanted to look for a good substitute here for operating cash flows instead of just free cash flows, because we also wanted to account for the huge investments that the company carried out in past years in our valuation. So in this way, we are also reflecting these investments in the valuation we have here.
Okay. There is a certain risk that, basically one overlooks, the capitalized, R&D in these comparisons. The other question I have, was on, your ESG rating, that you showed, did you look into why, the company has such a relatively poor governance rating?
That's a good question. Simon, could you go to, yeah, exactly. Thank you. So we have looked at the governance, and what we understand is the main reason why we did not mention governance is because we do not think that it impacts the performance of Temenos for the investors in any negative aspect. As the scores, as you can see, suggest that governance is above average for Temenos and its industry. So Temenos is already strong there. And the main reason for the scores to be low is mostly attributable to the fact that the management has been changed. As you can see in the center, that there has been quite a few changes, and this has affected the scores. But we believe that currently management is very strong, and we continue to believe in their expertise, and the way it is laid out right now will be proven fruitful for the upcoming years for Temenos.
Good, thank you. Best regards to Lugano.
Next question comes from Florian. Esther.
Yes, thank you very much. One of your arguments in your EBIT or in your margin bridge is that G&A or SG&A has been fairly stable. Can you show me how historically SG&A growth has been in comparison to revenue growth?
Yes, as you said, or as we said, G&A is a relatively fixed cost.
No, can you show me that it has been fixed historically?
We don't have the numbers on that, but it has been historically fixed. But of course, it's also been growing. Compared Temenos today to 5-10 years ago, it's a larger firm. So therefore, it's also growing, but not just at the same pace.
And maybe secondly, while we're on the topic, can you talk about how you have modeled the margin impact from the SaaS transition?
Yes, for sure. So as you know, SaaS gross margins is around 50% right now compared to the license gross margins, which is around 85%. We think that gross margins will decrease a little bit in the next 2 years as SaaS is getting a larger share of the total revenue mix. But we think at around 2024, it will be close to the license. So when we're looking at our 2024 numbers, we think that the impact will be minor. But until then, so we'll have some headwinds initially in the next 2 years.
How big is that impact? Sorry, I mean, while you say it.
We expect gross margins to fall by around 50 to 100 basis points for the next 2 years, and then it will turn again.
Thank you.
Next question comes from Peter.
Yes, you spoke about EV/EBITDA multiples. Have you, in that context, also looked at cash conversion from EBITDA, i.e., how much free cash they generate compared to their EBITDA and compared to their peers that you used in your EV/EBITDA comparison?
Thank you for the question. Yes, we have looked at that. And Temenos has a goal of converting 100% of its EBITDA to operating cash. But of course, there's investments. We expect investments to be around 5% of revenues in CapEx for the next years. So therefore, of course, they will convert less, but it will be in the around 70%, we expect. And to compare that to the competitors, I would say as a general answer, yes, it's somewhat similar, although especially some of those companies we compare to in the banking software sector, they are more type of a consultancies, the Indian players, Tata and Infosys. So they have a slightly different structure, but in general, yes.
The next question comes from Markus Martusek.
Hi guys, thanks for the presentation. I have a quick question with regards to what you mentioned at the beginning. You said that Temenos is serving more than 40 out of the top 50 banks. Insofar, you only have a little bit of room left, right, to penetrate that market. So thereafter, you have to basically go to lower tier or smaller banks. What is your view about penetrating that market? Do you see costs increasing? What is your sense there?
Thank you very much for your question. So having Temenos a low market share of 7% globally and with 25% of core banking in Europe, we think that the European market is quite consolidated by them. But there's been a shift of focus into the US market, which represents 40% of the total addressable market of Temenos. And after the acquisitions of Kony and Avoka, we believe that there's great room to grow, especially in the US.
But do you think that they can uphold then the margins? Because if you're going after smaller banks, right, you will have most likely higher acquisition costs. For one, and you also will have consolidation, within smaller banks, right? So hence the question: can you uphold the margins?
So relating to the margins, of course, they will have a greater number of clients, which could translate into a bigger cost, which could have a negative effect on the margins. But also, since we expect all these clients to onboard slowly and more commonly through SaaS, which in the long term will have a positive effect on the margin, we think that it will compensate that loss.
Okay, thanks a lot.
Next question comes from Peter Romanzina. Sorry, thank you very much. Well done.
Thanks a lot. Bye-bye.
Thank you.
Bye-bye. Bye.
Bye.
Bye-bye.
Bye.
So we will be back at 15:50, and the next presenting is University of Bern. Okay, so the next team presenting is University of Bern. Welcome to Daniel, Joel, Colin, and Rachel. Students, if I may please ask you to pin my video on top so you can see me when I wave after 9 minutes. I will also give you thumbs up so you know that you have only 1 minute left. You can upload your slides now. Okay, we see them. So we are ready when you're ready. Good luck.
I think your microphone is still muted, right?
Temenos markets itself as the banking software company. We, as the team representing the University of Bern, challenge this confident statement and would like to present to you why Temenos rather is just a banking software company. Whenever you open a mobile banking app or bank employees, for example, analyze customer data, banking software is needed. With Transact and Infinity as their most important revenue drivers, Temenos offers end-to-end software packages to financial institutions worldwide. But the company is not the only one, as the third-party market is highly competitive. Nevertheless, the majority is still spent bank internally, but currently reduces Temenos' addressable market to $14 billion US. We say no to an investment in Temenos and issue a sell recommendation with a target price of 72 Swiss francs and a downside of 31%. It's time to face valuation reality, and here's why. 1. Temenos bets too much on its future growth in the Americas. 2. R&D and M&A activities as the two pillars of innovation start crumbling. 3. The shift from licensing deals to software as a service will lower margins in the midterm, opposing analyst consensus. And 4. Governance issues increase Temenos' downside risk potential. Daniel will now elaborate on why Temenos' shift to the Americas will not bear the expected fruits.
With a share of over 40%, Temenos' home market Europe is the company's main source of revenues. However, as Temenos only sees limited growth opportunities in APAC, MEA, and Europe, the company centers its future strategy around the Americas. Temenos has been trying to capture the US through various acquisitions and partnerships. Through those deals, Temenos experienced strong growth over the last years. Yet organically, the company has just grown in line with the market. The acquisition of Kony in 2019 for a record high price is the most recent attempt to finally break through in the US. However, Kony clearly is no perfect fit to Temenos' strategy, with a big part of customers being non-banking clients. Furthermore, Kony is known to be a US SaaS leader. Let's take a look at why this is a problem. Temenos wants to build momentum with Tier 1 and 2 banks. Yet software licensing revenues from those clients have stagnated. So, in order to change this trend, Temenos would need to improve its offer for the Tier 1 and 2 banks. As CFO Spiliopoulos' statement shows, this does not happen through the SaaS leadership of Kony. Both Kony's SaaS expertise and Temenos' strength in standardized software are more attractive for smaller banks. Temenos, in consequence, will mostly miss out on the targeted Tier 1 and 2 clients. Despite the questionable strategy, we project the high efforts in the Americas to have a positive impact on Temenos revenues, but only in the short term. Together with the realization of postponed projects due to COVID-19, this will enable revenues to recover to pre-crisis levels quickly. However, as those two effects prove to be temporary, growth will start to diminish in the long run and revenues will remain far below the targeted levels. While in the past, Temenos was able to meet or even exceed its guidance of 10 to 15% revenue CAGR, Future growth rates will fall below the high expectations. Temenos, therefore, will remain just one among many banking software companies, rather than becoming a market leader. We have just seen how the questionable strategy in the most promising market impacts Temenos revenues negatively. Joel will now explain to you why organic growth will diminish even more due to a lack of innovation.
Temenos spends 28% of its revenue on R&D, which is almost twice as high as its closest competitor. This effort would result in the development of new and innovative products. Shockingly, this was not the case in the last 5 years. The only product which has been developed in-house is country model banks, but this is rather a country-specific customization of the existing product portfolio than a new product. The high investments seem to be necessary in order to keep the broad portfolio up to date, rather than developing innovative products. Acquisitions have often been the driving force behind growth and an expansion of the product portfolio. Through the active M&A strategy, Temenos significantly levered its balance sheet. This peaked in a net debt to EBITDA ratio of 2.8 in 2019, very much opposing the trend of competitors to have little to no debt. Because Temenos wants to reduce this figure, such an aggressive M&A strategy as in the past will no longer be possible. Without the help of M&A and with very limited internal innovation, Temenos growth will slow down in the coming years. Especially organic growth will suffer from this development, fall to below 5% CAGR in the midterm and almost disappear in the long run. So, despite high R&D spending, the lack of internal innovation and the limited future M&A potential will slow down growth. But enough of unsatisfying growth prospects. I will now present to you why the ongoing shift from software licensing to SaaS is rather a threat than an opportunity. As the management said when presenting the Q3 results, SaaS is expected to start cannibalizing some licenses going forward, which leads to deferred revenue streams. In addition, the vendor lock-in effect decreases due to the higher standardization of SaaS. CFO Spiliopoulos stated that the shift to SaaS has a short-term negative impact on the EBIT. We agree and project a mid-term margin bump. However, analysts still project growing margins. Therefore, this evolution is not yet included in the stock price, even though it is highly probable. Software companies as Microsoft and Adobe have already gone through this change and suffered a margin bump. So, the shift to SaaS will pressure Temenos margins, opposing analyst consensus. Let's now hear from Rahel how the ESG analysis impacts our risk assessment.
Temenos achieves solid ESG scores according to Refinitiv and the DVFA scorecard. Sounds promising, right? Well, 2 governance risks should change your opinion. First, 87% of management's compensation is variable and mainly tied to non-IFRS KPIs, which are not based on any comprehensive set of accounting rules. Taking a closer look at IFRS versus non-IFRS accounting, the problem becomes clear. Management would not have reached their bonus targets by IFRS measures, leading to alarming management incentives. Second, Temenos has gone through multiple changes of key personnel while integrating Kony and battling COVID-19. Compared to SMI companies, Temenos stands out with a high rate of refresh, which lowers leadership stability, especially in these uncertain times. In short, the governance situation increases Temenos' downside risk potential and impacts our scenario analysis. Colin will now illustrate our valuation results.
The cash flows of the DCF model are discounted with a WACC of 7.93%, derived by the CAPM and the average yield to maturities of the issued bonds. On the other side, the terminal growth is made up by weighing the expected GDP growth rates by the regions in which Temenos will generate their future revenue. The classic sensitivity analysis reveals that in only 7 out of 49 cases, we end up with a buy. 63% of all cases support our sell recommendation. A very similar picture emerges from our second sensitivity analysis, where we examined changes in the EBIT margin and revenue growth. We took different risks regarding the valuation and the company into consideration. while a high long-term revenue CAGR of 15% or an unexpected US market breakthrough would change our recommendation, the gray sky risks would lead to an increase in the downside potential of Temenos' share price. Since the EV to EBITDA and price to earnings ratios are both prone to accounting standards, we use the forward EV to sales multiple to compare Temenos to its most similar peers. This resulted in a high downside of 42%. Now, looking at how we conducted our sell recommendation, we used a weighted approach of the discounted cash flow and the multiples assessment. Putting these two together, our resulting target price amounts to 72 Swiss francs, which implies a downside to the current market price of 31%. So, since the growth prospects of Temenos are overestimated, the shift to SaaS is not yet included in the market price, and we find a troubled governance situation, we recommend that you take this wake-up call and don't invest in Temenos. Thank you for your attention, and the floor is now open for questions.
Very much. Judges.
I will ask the first question. You are forecasting an organic growth of 4.9%. Does that include market share gains or market share losses? And where are they going to or coming from?
So our forecast includes market share losses. If we can go to slide, the market development slide, please. This would be slide 40. Exactly. As you can see, so this is in terms of total revenue growth. We still get a market share decrease in the long term. So in the short term, they will gain some market share, mainly due to their high efforts in the Americas and because they suffered more than competitors from the dip due to COVID-19. So in 2021, 2022, there will be some room for improvement when they get back to their usual levels. Now, as we've seen, they will mostly miss out on their targeted tier 1 and 2 clients, where they see most potential lying there, as the big banks right now are in the transition to either outsource their software or at least to get it to the newest standard. As their strategy does not fit there, the market does not fit the tier 1 and 2 banks. They will not be able to gain more clients from this sector, and therefore they will lose market share there. So that's the main reason. And then overall, the organic growth will diminish in all regions, among all segments. So that will lead to a market share decrease to competitors that exist already, or also to the entry of fintechs.
Thank you. And the next question comes from Christoph Gretler.
Mr. Gretler, you're on mute.
Sorry, it's better now, huh? Thank you for this enthusiastic presentation to the Bern team. Just one question. I mean, one of your kind of rationale to sell the stock is this margin pressure coming from the license to the SaaS transition. So did you actually look into the value impact of this transition? I mean, I can follow obviously kind of the margin pressure argument, but do you think it makes no sense economically to do this transition? So if you were kind of the company, do you think it's actually a good idea? Or basically, just looking at, margin expectation, and if you want to, deliver on margin expectation, consensus margin expectation, or do you see an argument actually, to do the transition in a value creative way?
Thank you for the question. It's a good one. It's an important one for Temenos. As you see on the right side of the slide, the transition to SaaS is actually a good idea. So the margin improves in the long term. That's clear, because actually, yes, the SaaS business has higher margins because it's way more standardized, and you can implement the software way easier. But in the short term, it's actually not very good for Temenos, as you can see on the right side of on the margin slide, on the margin graph. The margin goes down over the next over the next 4 years, and actually that's due to the lower vendor lock-in, and more important, due to the later revenues, the deferred revenue streams. So to answer in short, actually, in the short term, it's bad for Temenos, but in the long term, it's good. And what we say is the short-term bump is not implemented in the market so far. And that's the problem to the stock price.
Mm-hmm. Obviously, the question is now with the stock off from 180 to 100, whether that's not already kind of priced in and understood by the market. So that's basically kind of the buy side guys already have that, in mind, and the sell side continues just to be over enthusiastic. So, but it's a good, clear opinion. Thank you for it.
Mm-hmm. Thank you. The next question comes from Rahul Sengupta.
Hi, thank you very much for your presentation. I like your contrarian view on the market. I would like to understand a little bit more about the 3 pillars you showed at the beginning of your presentation. So we have the core banking system, but we have also very attractive fields such as payments. So what is Temenos' strategy there, and what is the growth potential there? So to a little bit counteract your recommendation.
Thank you for the question. Well, you're right. The two most important products of Temenos, as you can see here, these are Transact and Infinity. And as a good example, the payments part, the payments product, Temenos will sell it in the next year, as they said, but it's not their focus. They don't lie their focus on payments. Even though payment has a good growth prospect, actually they project 10% CAGR for their payments product, but still it's not their focus.
Okay, and maybe a follow-on question to Christoph's question. You mentioned also during your presentation that Microsoft has gone through this dip of the SaaS transferring the model to the SaaS model. So most of the software companies are doing that. So why shouldn't it be good in the long run? Why the market has not factored it already into the share price?
Okay, thank you for the question. Rahel, maybe you can go to slide 41. Here you can see the margins for Microsoft and also Adobe over 8 years. So as you can see here, we project more or less the same, the same line of margins for the future. So in the long run, it's good for Temenos. The transition to SaaS is good for Temenos and for other companies because they give higher margins. But what we say is in the short term, it's not good for Temenos. And even though some people know that, the analyst consensus doesn't project this margin bump we see and we believe in. And that's the problem what we see, and not the long term. In fact, the long-term margins are better than the actual ones. That's true, but that's not the problem.
Thank you very much.
Mm-hmm. The next question comes from Peter Romanzino.
I have 2 questions. On the one hand, you say it's good in the long term, it's bad in the short term, the transition to SaaS. But given that you value the company with a DCF, the DCF is very, very, very much geared towards the long term, because the value of the company coming out of the next 3 or 4 years discount the cash flow is probably about 6, 7, 8%. The whole rest comes beyond 2025. So basically, if you're saying this is a good in the long term, you should be enthusiastic about it. How would you counter that argument?
We would counter that argument as we see very low growth prospects in the long term. So it's kind of EBIT margin and growth prospects go in opposite directions. So while we see some growth in the short term, we see very little growth in the long run, whereas margin goes the opposite route. Now, the growth in the long run, we already have lower growth rates, total growth rates than implied in the market. Now, we forecast that organic growth will fall to about 1% in the long run. So the rest, or the biggest part of their growth, will come from acquisitions. Those acquisitions then again lower the cash flows, and therefore cash flows are lower going into the terminal growth. And therefore this will overcompensate the benefits from the EBIT margin from the shift to SaaS.
And if I look again at this margin bump that you project, if I look how much the company sort of has turnover with SaaS and initial licenses, how much of a transition did you factor in order for the margin to drop so much in the short term beyond the 2020 COVID year? Just as a mix, because this comes from mix, your margin bump.
Yes, so for the long run, we assume or we forecast a share of about 50% from SaaS of total software licensing. So it will equal the classic, the traditional licensing revenues. Now, we did not imply a drastic fall in the margins. If you take a look at Adobe and Microsoft, they had much worse dips in the margins as they had to transition their entire business to SaaS. So actually those 2%, if we compare it to Microsoft and Adobe, are very little that they have to suffer.
Is that not due to a completely different industry? I mean, Adobe, everybody can have this in the cloud, while large banks, their large customers will still have it on premise. So it's not comparable. The business mix shift is absolutely not comparable of a Microsoft Adobe versus Temenos.
Thank you very much for the question, but 10 minutes is over. Thank you, our students.
Thanks a lot, guys.
Thank you.
Thank you too.
Thank you,
Thanks a lot.
Thank you.
Okay. So we are going to make a short break now, and we will be back at 4 o'clock. University of Galen presents next. See you later.
Good afternoon.
Hello. Hello, everyone.
Hi. Are you ready?
Yes.
Very good. So we will wait 1 more minute before we start.
Hello, everyone.
Hello.
So welcome back, everyone, after the break. The next team to present is University of St. Gallen, and with us are Shuwen, Dan, Mark, Javor, and Matthias. Students, if you don't mind pinning my video at the top, so you can see me, I'm going to wave after 9 minutes. I'm also going to leave you a thumbs up sign, and we'll stop your presentation in 10 minutes. Okay? You can upload your slides now.
Good. I believe everyone should be able to see the slides now.
Yes. Oh, good.
Good.
So good luck. We are ready when you are.
Thank you very much. So, hello and welcome to the Swiss final of this year's CFA Research Challenge. On behalf of SNG 500, I'm delighted to present to you the results of our analysis into Temenos. I would like to start off with an allegory. You will most likely be familiar with the tale of Icarus, the man who made himself wings, only to come crashing into the sea after flying too close to the sun. We believe this tale of hubris has great parallels to Temenos, which we would now like to elaborate on. Temenos is a banking software company founded in 1998 and headquartered in Geneva. It offers premium end-to-end software solutions which cater exclusively to the banking sector. Most prominent among its products is Temenos Transact, its backend offering, which accounts for about 2/3 of the firm's revenues. We initiate coverage in the company with a sell recommendation and a 13% downside on its closing price as of February 8th, 2021. The core elements of our reasoning are that banks are too financially weakened to have the funds available for premium software, a strategic push into the United States will encounter great obstacles, and Temenos' financial state does not help to improve the firm's prospects. And on that first point, I will let Shuwen elaborate.
Thank you, Mark. So Temenos likes to refer itself as the world's leading banking software company. But what is the use of that distinction if your target market is in structural decline? Unfortunately, this applies to Temenos customers, the banks. Since the global financial crisis, banks have been bathing in a low interest rate environment, which erodes the net interest margins that is a core component of banks' profitability measure. At the same time, an increasing number of regulations are put in place, but banks are hindered by these regulations as they add more complexity in compliance and therefore additional costs, which further lower banks' profitability. On the other hand, the new entrants, such as the big techs and the fintechs, don't have to comply with as many regulations as banks do. So taking this advantage and combining it with their technological heft, the new entrants are able and have begun competing in a large range of banks' profitable segments, such as business loans or credit card business, for example. So with a low interest rate environment, ever-increasing regulatory requirements, and the entry of new competitors, banks' return on equity cannot even meet the costs of equity. And this drop in profitability limits banks' available cash flows for premium banking software products, thus weakening Temenos' outlook in its main market. Our analysis also indicates another issue that Temenos is facing, and I would let Matthias elucidate this matter.
Thank you, Shuwen. So the second reason for our sell recommendation is that the US expansion, which is a key pillar in Temenos' strategy, is not going to be successful. First of all, because of the sticky nature of relationships in the United States, Temenos won't gain relevant market share from its competitors. If you look at the current US banking software market, you can see on the left-hand side that we currently have 3 very strong incumbents, FIS, Fiserv, and Jack Henry, while Temenos only captures a very small fraction of total revenue. At the same time, banks are biased against switching their software provider. As you can see on the right-hand side, in a recent survey, only 21% of bank directors indicated that they were completely satisfied with their current provider. But on the other hand, only 7% considered switching very likely, because switching involves a high risk of disruption and a high failure rate of around 70%. Secondly, the US banking market is losing momentum. As you can see on the left-hand side, the number of US commercial banks has been declining for over 30 years now, which of course reduces the number of potential customers for Temenos. Apart from that, only 25% of investors have faith that banks can successfully digitize their current systems. So it will be difficult for Temenos to onboard their remaining banks as well. And while organic growth prospects are bleak, acquisitions won't add a significant number of new customers either, because so far, M&A for Temenos has been a constant story of overpromising and under-delivering. They've paid huge premiums for their acquisitions in the past, but these ultimately failed to meet the expectations. And with a specific focus of the US expansion in mind, you can see that only Evoca and Coney added a handful of customers in the United States. But compared to the market share of Temenos or its competitors in the region, the impact of M&A to customer growth is negligible. With that, I'm going to hand it over to Dan.
Thank you, Matthias. So keeping the macro and strategic perspectives in mind, we have concerns regarding Temenos' future financial performance. In terms of revenues, we've received a declining growth rate as a result of a shrinking EU market and limited expansion in the US. Furthermore, we foresee this declining growth rate exacerbated by the introduction of the SaaS model, which will cannibalize licensing revenues, thereby splitting 10-year lump sum payments into fractured yearly fees. The introduction of SaaS will thus decline margins in the short term until it reaches a recovery point, at which margins will improve due to the markup that SaaS offers by cloaking its costs in a bundle. However, there is a concerning development on the cost side of the margins. As over 50% of Temenos' employees reside in India, where wages are expected to rise by 9% per year, Temenos will have limited control over its employee salaries. Thus, cost inflation puts Temenos in a difficult position. With wages rising quickly across the globe and regulations in India restricting employee mobility, Temenos may have to limit its R&D expenditures in order to maintain these margins, which will harm its status as a premium player. There are also worrying concerns evolving on the balance sheet. Temenos' aggressive M&A activity has pumped its asset base full of goodwill. This drastically increases the risk on equity in the event of impairment. Worsening the matter, the acquisition spree has levered the firm and dried its cash reserve, forcing the firm to take a step back from M&A in a rapidly consolidating industry with high valuations for tech firms. Now onto the valuation. We conducted our valuation of Temenos through a blend of discounted cash flow multiples and residual income analyses. This has yielded a target price of 96.8 Swiss franc, a 13% downside on the last closing price. Our discounted cash flow analysis has been assigned the largest weight. We discounted the free cash flow to WACC of 7.4%, which has been derived using the CAPM and regressing the firm with the SMI. Moreover, a terminal growth rate of 3.1% was used, which comes from an even split between the long-term GDP growth rate of Temenos' relevant regions and the long-term IT spending growth rate. A relative valuation made use of 4 multiples, namely EV sales, EV EBITDA, EV EBIT, and PE. And finally, our residual income model made use of the cost of equity of 8.1%. Now on to Yavor for the investment risks.
Thank you, Dan. Now that we've seen the more technical side of our analysis, it is time to take a look into some additional considerations that an investor should have. First, we will examine the ESG factors. As we can see on the left-hand side, Temenos appears to be committed to performing well on environmental and social issues, and we do not see any major concerns coming from these 2 pillars. However, the picture looks rather different when it comes to governance. On the right-hand side, you can see the main ESG issues that Temenos faces ordered in terms of likelihood and severity. Some of the governance concerns are questionable board independence, gender inequality on the board, excessive management pay, and above all, high management turnover. On the next slide, you can see on the left-hand side how these issues have led to a continuous underperformance of Temenos relative to its peers. To give you some more insight on the issue, the graph on the right-hand side clearly illustrates the significant turmoil in the executive committee. For example, in 2019, only 1 position remained unchanged. Finally, let's look into some general investment risks. In addition to the already discussed market and financial risks, the company faces notable implementation risk because it relies on a network of external consultants to implement its products. And now Mark will deliver the closing remarks.
Thank you very much, Javor. Now, having provided you with our analysis, I would like to reiterate our sell recommendation. The essence of the story is that Temenos' fundamentals cannot justify the current share price. With its customers under structural and financial pressure, organic growth difficult to come by, the firm's finances in risky territory, and shortcomings in ESG and particularly in governance, we think that Temenos, just like Icarus, would do well to adjust its level of ambition. And on that note, we thank you for your attention and remain open to your questions.
Thank you very much, judges.
All right, I'm going to start with the first question, right? You used three valuation model, discounted cash flow, relative valuation, and residual income model. Could you please explain why you selected these three valuation models?
Yes, I will gladly take this question. So Mark, could you please go to slide 72, the blended valuation, to just have an overview. So as you said, we use three valuation models, namely the DCF, the multiples, and residual income. We use the discounted cash flow valuation because it allows us to make very detailed assumptions about how we project Temenos' business segments to evolve, but also its cost base to evolve. Because what we currently see with Temenos is that we have two main product lines, namely licensing and software as a service, who are at different stages of their product development or their maturity. So it allows us to forecast different revenue growth rates for these segments. And then on the cost side, we, as we mentioned in the presentation, we are facing, or we are seeing a very high importance of our employee costs, especially in India, which we also wanted to model in a very detailed way. So that's why we assigned the highest weight to the discounted cash flow valuation. Then for the multiples valuation, we included it because we wanted to also get a feeling as to how the market is valuing the company and to get a better feeling as to what similar companies like other banking software providers are valued at. And then finally, sorry, we use the residual income model as sort of a backup or a hedge against our discounted cash flow valuation, because as you know, the discounted cash flow valuation relies heavily on the terminal value of the free cash flows. And the advantage of the residual income model is that it is based on the fundamental value, namely the book value of equity. And to have it grounded on the fundamental value, it is a bit of a backup or a security against the uncertainty that we have in the terminal value of the discounted cash flow terminal value. And so we arrived at a target price of 96.8 Swiss francs through the blend of DCF multiple and residual income.
Thank you. Next question comes from Peter.
Two questions actually. On the one hand, you sort of portrayed that the banking industry is consolidating, less and less banks. You showed a chart to this, insinuating that the market for banking software is shrinking. Why is that? From my understanding, it is not so important to how many banks you sell, but to the size of each bank and how much market share you have within each bank that you sell to. Why is that important that you showed that there are less and less banks?
I'm happy to address that question. Now, if we go back to the slide, now the argument we're making is not so much that the total banking software market is shrinking. That is not the case. The structural factors clearly point towards continued growth, be it digitalization or what have you. And it's absolutely true what you said about the importance of bigger customers. But the argument is rather, especially in the United States, there's an inherent bias against company or banks switching their providers. And given the strength of the three main incumbents, Fiserv, FIS, and Jack Henry, that works against Temenos, considering also the absence of success in the M&A strategy. So it's not so much a story about growth being absent. That's not the case, but it's rather Temenos' lacking ability to penetrate in a meaningful manner. That is the problem.
My second question would be, why is regulation, banking regulation, bad for Temenos?
Now, superficially, I'm also happy to take that question. Superficially, it is a benefit to software providers or technology companies in general due to the need for digitalization. However, if you look at the two main products Temenos is offering, the back-end and the front-end solution, now these two account for about 90% of the firm's revenues. On the back-end side, banks are more focused on a solution which is compliant with all applicable regulations, and then also offers them reliability, but there's little marginal benefit for a premium product from the bank's point of view. And on the front end, Temenos has, it sounds counterintuitive, but Temenos has the disadvantage of being a technology company, meaning that Temenos tries to offer banks a suite of software solutions covering everything from the back end to the front end. And in that sense, banks are more boxed in on the front end, meaning that they are less able to distinguish themselves in user experience, which is central to front end, obviously. So regulation superficially supercharges the need for digital transformation, and on the surface increases the demand for software in general, but not necessarily for a premium provider like Temenos. So the benefit of a premium product in that sense is exaggerated, and therefore also the benefit of increasing regulation.
Thank you.
Next question comes from Florian Ester. Florian, floor is yours.
Yeah, sorry. So this is a follow-on on Peter's first question. So can you show me what has been the bank IT spend growth in the US market historically, and what is your expectations over total addressable market growth first, and then what are your assumptions of historical market share evolutions for Temenos in the US market? Since that is your argument number one.
Now, if I recall it correctly, the total addressable market is growing at about 8% a year, 7 or 8% a year in the United States market. And this is, the forecasts are usually on a 5-year timescale, so up to 2025. So
how do you define that total addressable market?
That is usually conducted on a basis, well, you could take a very wide view and look at total IT spending. However, that is a rather expansive definition, and usually it's third parties spending on third-party software. And the addressable market there, to my knowledge, is based on Temenos data, $16 billion worldwide, actually. And the United States accounts for about 40% of global market. So that would take a addressable market of 6.5 billion thereabouts in the United States.
And then what is the market? What is your market share development assumptions for Temenos in the US market?
I think when it comes to growth, I can hand that over to Javor and move to the appropriate slide.
Yes, certainly. I'll be happy to take this one. So this is how we derived our growth model. So our growth models were not divided by different markets, rather we divided them by the different segments of the company. So if I can go, so first we projected the growth of the market, and then we projected the relative performance of Temenos relative to the market, and finally we added a COVID adjustment. And we did this for software licensing, SaaS, and services. And this is how we derived the growth rates for these segments, and maintenance is tied to software licensing. But we did not do the breakdown based on region. We made it based on product category.
Thank you.
And to add on what Javor said, can we go back to the appendix? So right now, Temenos has around 1,300 customers in the US. We can see it in the inorganic growth slide number 10. So we can see that Temenos has experienced, they can gain clients thanks to Avoca and Kony, but this addition, as we've explained during the presentation, is quite insignificant to the market share that Temenos has, because if we compare to the size of Fiserv, FIS, and Jack Henry, actually Temenos has a really small clients. We can go 2 slides back. Yes, so in the US banking software market, we can see that Temenos has on average 0.15 compared to, for example, Jack Henry is operating in the lower tier banks, but on average, their contract size is 0.95. So we can really see that Temenos has a small market share and small players in the US market.
Time is up. Thank you very much.
Sorry, thank you.
Thank you very much.
Thank you very much.
Thank you.
Thanks a lot.
Thank you.
Okay, so we are back at 16:30, and next to present is University of Lausanne. And joining us now are Luca, Constance, Alessandro, Paul, and Simone from University of Lausanne. Welcome.
Thank you.
So before you upload your slide, can you please pin my video on top? I'm going to wait until 9 minutes, so you know that you have only 1 minute left. Yeah, and after that, you can upload your slides.
Can you see my slides?
Yes, we can see your slides. Hey team, so we are ready when you're ready. Good luck.
Just checking the slides. Good afternoon. We're at the University of Lausanne, and today Constance, Luca, Simone, Alessandro, and myself represent you our sell recommendation for Temenos, a market leader flying blind. We forecasted a 26% downside with a target price of 92 francs. This recommendation is based on three main reasons: the failure of the US expansion, an inefficient capital allocation, and over-optimistic expectation from both the management and the market. Today, banks are facing an increased cost pressure. Indeed, they're relying on outdated legacy softwares that are extremely complex. As a result, up to 68% of bank IT expenditures is not to develop new softwares, but rather to maintain and operate the outdated legacy softwares. Banks are evolving in a low interest environment that is pushing the net interest margin under pressure. As we expect this environment to remain in the future, it will further urge banks to cut costs and modernize the systems. While we expect this market to experience a V-shaped recovery in 2021, these two main drivers will further push banks' IT spendings for softwares in the future. As a result, we expect this market to experience an 8% CAGR in third-party softwares and a CAGR of 4% in the total addressable market. Today, Temenos is one of the main players. However, in the future, we expect the company to lose market shares from 7.5% to 7.1% in 2024. This loss of market shares will be mainly due to an intensifying competition for pure SaaS players, the failure of the US expansion, and the cannibalization of revenues from the SaaS offering. Now, Simone will further explain you why we think the company will fail in the US.
Thank you, Paul. The expansion in US, which is the biggest addressable market for Temenos, represents a key pillar of the company's strategy. Temenos is going after the top 100 US banks, which in our opinion do not represent a suitable customer target. First of all, big banks have huge internal budgets and important human resources that allow them to internally develop their own software solutions. Moreover, these big players have developed throughout the years highly customized systems which are very difficult to replicate with a standardized software package such as those of Temenos. Finally, especially the top 20 US banks are highly focused on investment banking, which is not directly covered by Temenos product offering. For all these three reasons, we believe that Temenos will have to switch its attention from the top tier US banks and focus more on the small and middle-sized banks. However, at these middle-sized players, competition is particularly intense, since three companies, FIS, Fiserv, and Jack & Henry, dominate the local market with a combined share of 80%. These players have developed long-standing relationships with both local customers and local suppliers, and are able to offer solutions which are far less costly than those of Temenos. On the other hand, small banks tend to prefer solutions which are highly customized and are offered by the new entrants, such as the pure SaaS players. Finally, the third issue related with the expansion in US has to do with the governance, for which we assigned a BBB grade and a weight of 50% in our ESG analysis. As we can see from the table on the left-hand side, only 2 members out of 7 of the board of directors have direct experience in the US software sector. On the other hand, if we look at the position of the President of the Americas, we can see a high level of turnover, which shows a high degree of uncertainty for a position considered to be key in order to successfully expand overseas. Now, Luca will guide you through the inefficient capital allocation.
Thank you, Simone. Observing the average R&D expenses ratio of the industry between 2015 and 2019, we can see that the level of Temenos is so elevated to have no rivals. In fact, it spent almost twice as much as Oracle and ACP, which place respectively second and third. However, what really matters is not how much you invest, but how efficiently you do it. With this regard, we evaluated the impact of R&D investment on organic growth using the R&D Efficiency Index. It shows that on average, in the last 5 years, Temenos R&D has been inefficient compared to the industry average. These results make investors aware of the fact that the company is allocating excessive capital to activities that are not supporting its growth. This situation will further deteriorate in the future, since the company will continue to invest at least 21% of its revenues in R&D. This waste of capital could be more wisely used in future M&A activities, which in the past contributed to increase the growth. Since all the companies that were acquired in the last 5 years were not listed, we considered the return on the date of the announcement to evaluate the quality of this acquisition. Markets have always reacted positively, with an average increase of 3%, confirming positive sentiments about these deals. Since Temenos claimed that it will continue with the M&A strategy also in the future, more and more doubts will arise about whether the level of R&D is appropriate or not. And now, Alessandro, could you give us more information about the financial situation?
Thank you, Luca. In 2020, we expect revenues to decrease by 10%, followed by a V-shaped recovery, assuming the finalization of the pending deals due to COVID. In the coming years, Temenos will experience a marginal decrease, ending its double-digit growth in 2025. During this period, it will generate revenue CAGR of 7.7%, far below the over-optimistic management target between 10 to 15%. We can say the same about the current stock price, which implies a revenue CAGR of 11.4%, in line with the management. The failure to meet the target, explained by the disappointing US expansion, is worsened by the ongoing transition from licensing to SaaS. Indeed, despite SaaS has been the main driver of revenue growth with a CAGR of 34%, this shift will cannibalize part of future licensing revenues. In fact, the portion of licensing contracts shifted to SaaS will generate a net cumulative loss of 64 million, mainly related to maintenance, which is already included in a SaaS contract. The transition to SaaS has also implications on profitability. Indeed, its actual lower gross profit, given its novelty, will hurt profitability in the short term. It will take 4 years for SaaS to converge at the same level of the other products at 75%. As a result, EBIT margin will require 3 years to fully recover from the COVID shock. The improvement in cost of goods sold, mainly driven by SaaS, is partly offset by higher sales and marketing costs, since SaaS will require more spending. In addition, G&A and OpEx will decline because of the scale effect in fixed costs and R&D. Nevertheless, this will not be sufficient to meet the management target of about 29%, which, as with revenues, are too optimistic about the potential of Temenos. Now, Constance will talk about the valuation and investment risk.
Thank you, Alessandro. We computed a price based on our DCF valuation, leading to a target price of 92 francs. We deliver a sell recommendation based on the 26% downside from the current market price of 124 francs. The cost of capital of 7% is based on a goal and on a cost of debt in line with the BBB rating. Compared to peers, Temenos is also overvalued, with an enterprise value of 11 times itself, twice the value implied by the market. This peer analysis is in line with the SAL recommendation. However, we decided to rely entirely on our DCF valuation due to a lack of comparables. We identified 2 key risks. The first regarding the US expansion, which is a key argument in our analysis. Hence, a successful implementation in the US would challenge our forecast and investment recommendation. Temenos invests heavily to mitigate data security risk, which represents a point of strength in the social factor of our ESG analysis, proven by the increasing number of certification and a total loss of $0 from legal proceedings. The company also shows higher training hours and lower turnover ratio compared to peers. Overall, Temenos benefits from an ESG grade of A. To conclude, given a strategic mismatch in its US expansion and an inefficient capital allocation leading to missing management target, we do not recommend investing in Temenos as its growth potential does not justify its current price of 124 francs. Thank you for your attention. The floor is now open for questions.
Thank you very much. Judges?
The first question comes from Marcus. Please, Marcus.
Yeah, thanks for the presentation. Well done. Can you go to the slide where you have the two valuation methods, please? Because it's probably just the confusion I have. You basically said, you're not doing any multiple valuation because you do not have any comparables. But on the other hand, you mentioned actually on another slide, that you have 80% of other players, and Temenos only represented in the 20% bucket. So clearly there are comparables, maybe not perfect ones, that you do have. So what did why did you come to the conclusion, right? What are the logics behind it that you conclude that you don't have any comparables at hand?
Well, it's firstly because we kind of we divided the comparables in two main groups. So first, the traditional banking software, which are here in light blue, and then the pure SaaS players, which are in dark blue. So for the first one, the traditional banking software, they don't have the wish to fully transition to SaaS yet. So they don't really offer exactly the same solutions. A lot of them also evolve in different industries, and the ones that are serving only financial institutions do not only serve banks, but also credit unions or insurance. So they don't exactly have the same client target as Temenos. And regarding the pure SaaS players, they have different growth potential and also evolve in different industries. For example, if we look at the last slide that we have with only pure SaaS players, we can also see that Temenos is very valued compared to those. That's why we thought that even with the comparables, we do not wish to take it into consideration in our valuation.
Okay, thanks for that. If I may, just add a second question. You said, that when it comes to the R&D spend, they are very inefficient, right? They are, below their peers. You also have a very nice chart with regard to the efficiency. Have you looked into, whether it would be possible for Temenos to actually, get in line with competitors in terms of R&D spending? Because it seems like, quote unquote, an easy one, right? You have to just spend smarter. And what that would imply in terms of, the other metrics, as amongst others, also valuation.
We observe that Temenos is investing too much. In fact, 80% corresponding to the 17% out of 22% is expenses in internal development. And this is the part that could be reduced, while the rest of 5% is to integrate product from acquisition. And that one is in line with the market. So the problem is the internal development that is excessively high, considering that they are investing in a much smaller portfolio compared to peers. So with the internal development, this could be a very important part for Temenos to reduce cost and increase also the valuation.
Okay, and do you think this is feasible, or are you just, stating the fact that currently, they are just inefficient?
No, well, it is feasible, but just Temenos should have reduced the internal R&D, which have proven to be inefficient, and focus more on the acquisition of external product from M&A activities.
Okay, thanks.
Thank you. Next question comes from Christoph. Christoph? Or Florian?
Sorry, I got unmuted.
Yeah,
it's fine. Thank you, Olivier. Thanks, team, for this presentation. One question. So you are recommending to sell the stock. So some of our clients, would short. So what's the risk, kind of, if you short, such a stock, and such a company in your view?
In our opinion, especially following the share price involvement today, it's even more a short today, especially since the share price today went up and is reflecting our growth assumption in terms of revenue. So our top line growth is still aligned with the one we had. The EBIT margin is slightly improved according to the figures that were reported yesterday by the company. However, we think that this improvement is just a one-time improvement because they only cut its costs recently to improve this EBIT margin, but which it's not going to be a long-term advantage, and we still would like to recommend this short to your clients in this case. And in terms of the downside for your clients, if they were shorting this position, we realized a blue-gray sky scenario, and in this scenario, and also we saw that the downside was way much lower. And also through a Monte Carlo simulation, we could see that in 90% of the cases, it was a sell still. So the probability of this short position to have margin call is quite low, I would say.
Okay. Well, how do you see the likelihood of Temenos getting acquired? Since this is a consolidating industry, and if so, who do you think would acquire such a business?
Maybe not for consolidation, but for example, companies that are offering consulting services in IT, such as Accenture, Temenos, and most of the market, they have partnership with them, and they could actually be interested in purchasing such a company, as they can capture most of the growth, most of the sales opportunities. It would be a good diversification for them, as they would be able to capture significant market share.
Good. Thank you.
Thank you. Next question comes from Florian Nestor.
Hey, one of your assumptions is that license growth forward will be 4.5%. Could you put that 4.5% into relations of the historical license growth as well as the addressable market growth?
Yes, sure. In terms of historical market growth for the licensing, it was much higher in the past, since licensing represented most of Temenos revenues in the past. And that's why now we expect this growth to be lower. And yeah, exactly.
So what was the historical licensing growth of the company?
Historical. Oh, yeah. Sorry, go.
It was 15% from 2015 to 2019.
So if we put your assumptions on licensing growth and SaaS growth together, how much would that be in a CAGR format, and how does that compare to the historical experience?
It will be around 10.5% between the period from 2019 and 2024.
And how does that compare to the total addressable market growth?
The total addressable market growth is 4%, but it includes also the spend in internally developed software.
And so then the total addressable market growth for third-party spend is?
It's 8%.
Okay, thank you.
You can see it in the slide number 3. We have the numbers. We divided between the total addressable market, which includes both the spend in third party and internally developed, and only the spend in third party.
Thank you. Next question comes from Peter.
When you look at your R&D efficiency, you look at total revenues. However, the company deliberately is not selling a lot of services. They outsource the whole service side. Shouldn't you, for the R&D efficiency, only look at software, i.e. ILFs and SaaS revenues, instead of maintenance and services, which has nothing to do with the innovations, particularly maintenance?
We also look in this way, looking also only in software licensing. However, the final result was...
Time is up.
Sorry.
Thank you very much.
Thanks a lot.
Thanks a lot.
Thank you.
Thank you.
Thank you.
Thank you. Bye.
Yep.
So we will be back shortly with the last presentation for today from University of Zurich. Hello, University of Zurich.
Hello.
Good. Before we start, may I please ask you that you pin my video? So, because I'm going to wave after 9 minutes so you can see me. I'm going to have a thumbs up sign so you know that you have only 1 minute left.
Mm-hmm.
Okay, you can upload your slides.
Yeah, just a second. Got kicked out earlier. Where's it? PowerPoint. Okay, just give me a minute.
Guys, can you hear me?
Yes, can. Okay, works. All right.
Perfect.
So
we are ready when you are.
Perfect.
Good luck.
What are you willing to pay for growth? That's a question we ask ourselves at the beginning of our analysis process of Temenos. To assess that, we had a look at the price earnings to growth ratio in the past 5 years, immediately spotting 2 outliers, one of them being Temenos, trading at a visible premium compared to its peer group. Over the next minutes, we want to talk you through why the market is overestimating the true potential of Temenos, why it's first overestimating its revenue growth, it's second overlooking the negative impact of the SaaS transition and only focusing on the good side, and it's third underestimating the true cost of its growth. All this leads to a sell recommendation from our side with a target price of 85 Swiss francs, a further downside potential of 25%. Temenos is a software banking provider focusing on core banking system, a heart of a bank, with its main product, Temenos Transact, making up 2/3 of its complete revenue. Other important products like Infinity, payments, and fund administration are serving the complete value chain of the bank. So let's zoom in on how each of these markets develop.
For our first point, the overestimation of revenue growth, we start off by looking at our top-down approach. In this, we see that the total addressable market will slow down over the coming years, with a CAGR being considerably below the historical one. This is behind 3 main factors. 1, a short-term COVID impact. 2, the continued digital transition by banks, but 3, a maturing banking software market. Moving on to the market shares. We forecast that Temenos Transact, their core banking offering, will become global market leader by 2029. This is behind a highly rated product offering and a breakthrough in the American market. For the rest of Temenos offerings, we forecast that their growth will be in line with the historical growth as Temenos continues its M&A activity, but cross-selling opportunities remain limited. Combining these two, we arrive at a forecasted revenue with a 13% CAGR over our forecast period. This falls way short of the current implied revenue growth based on the current market price. For our second point, the overlooked impact of the SaaS transition. We start off by looking at the characteristics of a SaaS contract compared to their traditional licensing plus maintenance contracts. We see that SaaS contracts merges 2 revenue streams into one and has a way shorter contract duration. This leads to lower short-term revenue, but an increase in long-term revenue. However, bear in mind that this increase is contingent upon the contracts actually being renewed. Looking at the cost side of SaaS, we see that currently SaaS gross margins are way lower than those of licensing. Temenos acknowledges this, but believes that SaaS margins will catch up in the future. However, what we see in the market is that tier 1 and 2 banks remain reluctant towards switching to SaaS. Therefore, at most 40% of Temenos customers will switch to SaaS. This has 3 major implications for Temenos. First of all, they will not achieve substantial savings in sales and marketing, as other SaaS companies have done. Second of all, they will not reach the economies of scale required in order to operate their own cloud. Therefore, third of all, they will have to rely on cloud providers with high pricing power. All of this leads us to the conclusion that Temenos will not close the gap in margins, offsetting the extra revenue earned.
Looking at costs, we can see that Temenos capitalized less and less in terms of total development costs over the last 3 years. Also, by comparing Temenos to its peers, we can see they capitalized way less than their peers, indicating one inefficiency. When we plot Temenos revenue growth against their spending on R&D, we can see that they fall short behind their peers on this spending, indicating another inefficiency. Temenos highly markets its non-IFRS numbers, which are currently 35% higher than the IFRS numbers. But bear in mind, they do not really differentiate between the two different intangible asset classes they propose, and also they do not account for their constant M&A activity. Therefore, we adjusted these factors in our forecast with our non-IFRS EBIT, leaving us 15% lower than Temenos numbers. Forecasting this EBIT margin into the future, we can see Temenos falls short of their midterm goal of 36% EBIT margin in the midterm in the different adjustments we already mentioned and the different SaaS impact.
Let's now look at ESG. We use the SASB materiality map factors to analyze the ESG performance of the company. For the environmental pillar, we find that Temenos has low direct emissions, implemented supply chain management and monitoring into its strategy, and that the resource use has rooms for improvements. We conclude that Temenos performs good in this pillar. Our research regarding the social pillar shows that there were no customer issues nor data security breaches in recent history, and that Temenos is a very diverse and inclusive employer. We conclude that the company performs strong in this pillar. When looking at governance, we see that the company was not involved in anti-competitive behavior proceedings and has few service disruptions and a low customer downtime for its products. However, management share sales and non-IFRS adjustments raise a red flag. On the left, we see that the share sales by the management are relatively large. This can indicate an overvaluation of the stock. On the right graph, we see that the non-IFRS adjustments done by the company have increased a lot in the past 2 years. And the management compensation is heavily dependent on non-IFRS results. As Moritz has pointed out before, these adjustments are too high and can overstate the profitability of a company. As a result, we downgrade the ESG performance for the governance pillar. Summarizing all this, we calculate an ESG impact of 2.5%, therefore lowering our beta by 2.5% and increasing our multiples by 2.5%. Let's then zoom in on the valuation.
We already heard about our 3 key drivers for future cash flows and how they're going to affect our revenue and earnings in the future. This leads to a stable free cash flow to the firm in the near future, only following afterwards with a steady increase. The present value of our projected free cash flows in the next 10 years result in $37 per share in our share price decomposition. For the terminal value, we use the fade rate model with the main drivers and as a competitive advantage period of 10 years, which is the typical renewal cycle for core banking systems in the bank. In addition, we adjusted our net operating assets by sales and marketing expenses, since Temenos is highly relying on the reputation sales structure, resulting in a present value of a terminal value of $74 per share. Reducing the net debt of $14 per share leads us to a final target price of $97 per share in our DCF valuation. On the sensitivity side, we can see that only a way higher terminal growth rate or competitive advantage time paired with a way longer cost of capital would lead to a deviation from our initial sell recommendation. But how does Temenos compare to its peer group? We can see in terms of EV/EBITDA, EV/EBIT, and price earnings to growth, Temenos is trading at a premium compared to the median of its peer group. Already after accounting for the ESG premium, the gap to the mean would be even higher, resulting in a multiple target price of $94 per share.
As Malte just pointed out, we arrive at a target price of $97 in our DCF and $94 in our multiples approach. With a weighting of 60% on our DCF and 40% on our multiples valuation, we then arrive at a target price of $96. Since Temenos reporting currency is the dollar, but it is traded in francs, we apply a 1-year forward rate of 0.88 US dollars to francs to arrive at a target price of 85 francs. In our analysis of different scenarios, we identified 3 key risk areas to our base case scenario. First, a faster revenue growth of SaaS that would be driven by big banks switching faster to SaaS. Second, outsourcing of the services faster than expected, which would lead to lower costs in relation to revenues and a higher EBIT margin. And third, highly effective R&D spendings that would reduce costs and lead to new signings due to more innovative products. Apart from that, we also considered the ESG performance, upselling and cross-selling issues, and a strong COVID recovery. To complete our analysis, we incorporated all these risks that we just analyzed into different scenarios, reaching a blue sky scenario price of 122 francs with an 8% upside potential. In contrast, we arrive at a gray sky scenario price of 52 francs with a 54% downside potential by considering a resistant banking sector, low cross-selling opportunities, and slow outsourcing of the services area. Summarizing the analysis that we did as a team of the University of Zurich, the overestimation of revenue growth, the overlooked impact of the SaaS transition, and the underestimation of costs lead us to a target price of 85 francs. So what is growth worth? The answer is not that much. And that's why Temenos is a sell. Ladies and gentlemen, thank you for your attention.
Oh, that was great. 9 minutes, 52 seconds. Thank you very much. Judges?
Thank you very much. The first question comes from Christoph Gretler. Christoph.
Thank you, Olivier. And thanks to the team for this enthusiastic presentation. Just one question, on your valuation, you kind of had this 60-40% split between DCF and multiples. How do you actually come up with that, and why is it not, 30-70 or 20-80 or so, Is there any kind of, thoughts behind that?
Mm-hmm. If we go to our page 37, our appendix, we can clearly see several positive aspects, but also negative aspects of each valuation technique. The DCF, in our opinion, is much more robust against current market fluctuations, and we have a much higher flexibility in different types of scenarios that we already analyzed in our presentation. Furthermore, if we go to page 91 in our appendix, we can see that in our peer group, we didn't have a perfect comparable company. We had good comparables, but in terms of line of business, size, and revenue CAGR over the past 5 years, they are not perfectly comparable. And that's why we decided to use a 60% weight on our DCF.
Thank you.
Perhaps continuing on your valuation, right? Why did you choose these multiples?
So if you take a look at our multiple selection slides, we choose the price earnings growth multiple since the growth is the key point we are looking at. The question we were asking is, why do we have to pay so much for that company and what's the effect of growth? On the other side, we looked at the EV/EBITDA and EV/EBIT multiple since they are independent of the capital structure. We looked at both of these multiples since the companies in our peer group had different adjustments in their different schedules for the cost they expense and they capitalize, and also to be robust for different D&A schedules.
Thank you. Next question comes from Rahul Sengupta.
Hi, thank you very much for your presentation. Very interesting indeed. So I have a question. You outlined a couple of risks to your recommendation at your, I think, closing slide or the one before. So which one of these risks to your recommendation would you make change your mind? Meaning, what would make you change to make a buy recommendation on this company? What does need to happen?
So we have several risks here that we have to consider. On slides 86 in our appendix, we can see several upside risks to our valuation, being a large portion of tier 1 and 2 banks switching from licensing to SaaS. Then another risk would be a fast outsourcing of the services area, faster than what we expect, and a more effective R&D spending. However, what the market currently doesn't get is that all these risks are linked to several mitigating factors that are reducing the risk of the stock price going up. And in our opinion, this is largely driven by banks that are resistant during that switch from licensing to SaaS, especially tier 1 and 2 banks.
Thank you.
Next question comes from Christoph.
Yes, actually, just following up on that topic, what do you think is actually the likelihood that, Temenos could be acquired?
Yes.
So sorry. For the acquisition related part, Temenos is of course a large company, but nevertheless, you have to bear in mind that there are no currently anti-takeover measurements currently in place, which is of course a problem. But nevertheless, we consider Temenos with its market size of almost 10 billion as of I think today, is a potential candidate in this situation.
You know, you wouldn't go as far as to assign a probability also, you know, kind of 5% or so. I mean, you have, you know, companies like Oracle also, for them, you know, 10 billion is no kind of breakfast.
No, if we please go to slide 80 of our appendix, due to the reason that Temenos has a very high EV/EBITDA multiple, it is unlikely that somebody will buy Temenos. And for example, Oracle will also most likely not consider buying Temenos, since implementing Temenos into its group is coming with huge costs. So the only competitors, or which are not competitors, but companies that would be considerable, are companies like TechGuidance, Amazon, or Microsoft, which is also not likely the case.
Thank you.
Maybe what is your assessment? Pardon? Yes, Florian?
No, go ahead. I do have another question.
How do you assess management quality? And what is your opinion?
Well, if we please go to slide 73 of our appendix, then we can see that management is actually quite new. Or if we even better move to the slide 78, where we can have an overview about the management. And most of them are quite long in the company, but not too long in this executive position. So it would be too early to really judge the management on its performance, also due to the impact of COVID-19.
Thank you, Florian.
Very early in your slides, you had an implied growth by the market of 19%. How did you derive that, and how does that compare to sort of the growth that analysts are giving? And couldn't that growth just be the issue that some of the assumptions you took to derive that were just wrong?
Yes, first of all, we start off by just looking at how we arrived there. We took the current share price and saw with our assumptions, what would the revenue growth be needed in order to sustain the share price that is currently. And for your assumptions and whether our assumptions were correct or not, I'll hand it over to Moritz, who can tell you more about the analyst estimates.
Yes, so the market estimations were actually really close in line on the top line with our assumptions. We also already a little bit overestimated the consensus of the analysts for the full year and also for the next years. But nevertheless, we had a bit more downside on the bottom line, resulting in a different scenario in this case.
Thank you.
So hanging on this topic, so you're saying that the market is overestimating the cost side in general, or underestimating the cost side?
Yes, so if you go to the cost analysis, we see two main factors for that. Like the main factor, if you go to the non-IFRS adjustment, is that the analyst and the market is truly focusing on these non-IFRS adjustments. And we see that they include a lot of recurring stuff due to the M&A transaction. So if you go one slide further to the adjustment bridge, you can see that they have part of the recurring cost for the M&A activities, plus also the differentiation between the two parts of amortization. So they amortize the acquired intangibles, and they add back the customer-based and the software-based amortization, but they should only add back, in our case, the customer-based ones.
Okay, thank you.
Next question comes from Peter Romanzina.
I struggle a bit with your implied growth rate. That means that the only factor you consider to look what the market implies. It's a one-factor model, it's growth. Have you looked at margin, use of capital or capital allocation? There is a multiple array that goes into a fair value. You look at one factor and say it's all growth. The rest doesn't matter. You couldn't be wrong on other assumptions. Why is that? Why do you only consider one factor?
So for our whole valuation, we are not only considering one factor. For
no, that's not what I mean. Sorry to interrupt.
For the implied growth, on the first slide. So we also compared the analyst expectations for their margin that went quite fast back to the 36% adjusted EBIT level that they wanted. However, for the implied revenue growth here, we assumed our margins instead of adjusting them for all the time. So
and that makes it a one-factor model.
For the slide where we have the implied market growth of 15%, yes.
Is that wise?
It would be more robust if we would include also the other adjustments, yes.
Thank you.
Thank you. The next question comes from Markus Matusek.
Yeah, you had a nice ESG analysis done, including, some conclusion that you're actually reducing the valuation based on, the ESG analysis itself. How much of an impact is that on the valuation?
I'm sorry.
Is it
10 minutes is over.
Okay.
Okay. Thanks a lot, guys.
Thank you very much. Congratulations. Well done.
Thank you.
So thank you to all teams who presented today. Our judges are going to deliberate now, and we will see you back at the award ceremony at 7 o'clock. Until then.
Thank you.
Bye-bye. Thank you. Goodbye.
Hello.
Hello, everyone.
Hello.
Hello, Jana.
Hi. So good evening and welcome back. It is my pleasure to open the award ceremony of the CFA Institute Research Challenge in Switzerland 2021. CFA Institute Research is a great test for all students who are bold enough to face it. But like any other great challenge, the rewards and opportunities it offers are even bigger. Research Challenge is about real-life experience of financial analysis. Research Challenge is about telling a story, because that is what is going to connect with people. One can do the most sophisticated analysis, but if you cannot communicate what it means and why people should care, it doesn't make the same impact. Research Challenge is about teamwork, and we understand how difficult it must have been for students this year to work remotely. And finally, Research Challenge is a confidence-building experience. So, dear students, we are very pleased and very proud with what you have achieved, and we look forward to seeing what more you will achieve in your professions. CFA Institute Research Challenge would not be possible without our volunteers. This year, we have been supported by more than 80 volunteers of CFA Society Switzerland. And those were industry experts who gave lectures to students, industry mentors who worked closely with students on their reports and presentations, graders who reviewed and graded reports, and finally judges who you met today. Thank you all for your time, passion, and expertise you shared with students. Dear professors and assistants, thank you very much for organizing courses and teaching students. We hope you enjoyed the experience, and we look forward to welcoming next generations in this competition. And a big thank you to University of Zurich for hosting the kickoff meeting last October. We would like to thank our partners and sponsors now. A big thank you to Finance and Wirtschaft, who has been covering Research Challenge for many years now, and who is providing students with free online subscription to their news portal. A big thank you to Karen Cody from Conti International. She's a brilliant presentation skills coach and one of the biggest fans of the Research Challenge in Switzerland. Karen is also very passionate about working with students and developing talents. Finally, thank you to Credit Suisse. Credit Suisse, through its experiences and campus recruitment in Switzerland, has been generously supporting Research Challenge for 12 years now. Over the years, our relationship grows stronger, and we look forward to working together in the future. A big thank you to Janine Hochstrasser, Orfe Chateau, and other colleagues from Credit Suisse. And now I would like to invite our first keynote speaker, Marissa Drew, Chief Sustainability Officer and the Global Head of the Sustainability Strategy, Advisory and Finance in Credit Suisse. Welcome, Marissa. The floor is yours. Is Marissa on the call?
I think we just lost her a second ago. Let me just check. Or I think she's back again.
Yes, she's there. Marissa, can you hear us? Okay, I will invite then our second keynote speaker, Monica Rancati from Temenos, our subject company. Monica is Chief Human Resources Officer at Temenos. Welcome, Monica.
Thank you very much, Miriana, and thank you to CFA and everyone who is part of this initiative. I'm really delighted to be here with you this evening or this afternoon, depending on which part of the world we are, and really have the opportunity to share the appreciation from behalf of Temenos for the work and the contribution that all of you have offered us participating into this challenge and really sharing your insights, your perspective, and the richness of what you are experiencing every day. I've been really brought up into that, and I learned that we had a very large number of students from almost 12 universities organized around 32 teams and really delivering outcomes that have made our life, the life of our judges, extremely difficult to pick from and choose from in terms of the quality, in terms of the innovation and the efforts that have been put into that. Even more in a year like 2020 that we all know how unprecedented has been, but to see the passion, the energy, and the commitment is positively overwhelming and is a great inspiration and example for all of us. Let me just share a little bit about Temenos. We are a banking software company and an organization with a strong sense of purpose and with a strong vision, which is really to provide financial institutions of any size around the world technology to thrive in the digital banking age. And as a matter of fact, through that, the opportunity to bring banking to everyone in a sustainable way around the world. If you can move to the next slide, just to give you a sense of who we are. We are approximately 7,500 people around 150 countries around the world. We are the third largest European software company from a market cap perspective, with the reach of 1.2 billion, and it might have grown in the meantime, people around the world that are really have access to bank and banking services through the capabilities that our software offer to our customers around the world. We've got approximately 3,000 banks as customers. 41 of the top 50 banks are part of our portfolio, and we are facilitating to manage more than 2.5 billion transitions on a daily basis. I'm not sure the impact that this has on you, but frankly speaking, when I hear the story, when I listen to the story every time, it has a positive, overwhelming impact, and really in terms of the impact we can really have on people around the world. But this is not what we are driven from only. We are also driven from making sure that we continue to drive value creation around the world in a sustainable way. And if we can move to the next slide, what our company, my team, is really focused on is making sure that everything we do is sustainably tested and vetted in a way that we can have a broader impact into the society. And it goes from environmental sustainability, which I understand in some cases is difficult to grasp from a technology company, but also from our data centers and our systems, we need to make sure that we do things right, to the social aspect of that. If I think about also the crises and the difficult moments that the world has gone through 2020, through microfinancing services, having the opportunity to reach broader population around the world and make credit available to them is absolutely important. We've done a lot of work around diversity and inclusion around the world, and our employees are frontline volunteering in multiple initiatives, from supporting the communities, helping in upskilling people in technology, and making things better in the countries where we operate. And finally, a sustainable and responsible governance is core to our values as well. And we need to make sure that everything we do is done in the right way to reflect our values and to reflect what we believe into that. We've got almost 27 years of deep experience in this sector. In fact, we were born in Switzerland, in Geneva, and we feel really proud about that and about what we do every day. And if you will ever be curious about Temenos and exploring what means as well being successful at Temenos, I make myself available. You can find information in our website, and you will be more than welcome to have a dialogue and have a conversation about the future as we constantly look for opportunities to onboard young talent, graduates, and really to leverage from your experience, your insights, and your fresh eyes into what we are doing every day. Thank you again very much for your contribution and your passion. And Mirjana, I will give it back to you so to allow the other panelists to join us.
Thank you very much, Monica. And thank you to Takis Piliopoulos for actively participating in the competition this year. Fortunately, Takis couldn't be with us today.
And today he cannot be with us because it's a big day for us. We've got a capital market day, and so we are at the moment in a roadshow with our investors and future investors, and there's no one better than this community who can understand the value and the importance of that, and that's the reason why Takis unfortunately couldn't be with us. But again, thank you for that, and thank you on his behalf.
Thank you. So I think Marisa is with us. Marisa, can you hear us?
Hi, this is Dana Barsky from Credit Suisse. Marisa asked me to jump in last minute. She's having serious technical problems. Hi. Oh, sorry, go ahead. Marisa, are you back? Nope. If it's okay, I would like to jump in for her. I think the first lesson for this is always have backup. And so, it's my pleasure to be here today. I love seeing everyone here in their suits. It's just, apologies, I'm so casual. It's making me feel like I'm not ready for the occasion. I'm Dana Barsky. I'm the Chief Operating Officer of the Sustainability Strategy and Advisory Department. I work for Marisa, and I'm going to jump in here cold. I started at Credit Suisse in 1995 out of Harvard Business School. I started my career as an M&A banker, moved on to venture capital, and then I joined in this capacity about 3-4 years ago, focused on sustainability. I like to say I'm a reformed investment banker. If you could move the slides, I'd like to see, I don't even know what she has in the slides, so not that page. Top career tips. I know I'm very much aligned with Marisa on do's and don'ts, so I would like to spend a little bit of time on this page. I think we really both, share very similar goals as to goals, I would say, as to what makes success in an institution that's as large and complex as Credit Suisse. So I'm going to go through some of these. Really, I think some of the tips I would give would be always be the go-to team member and own what you do. I think that's so important. I see that in our team that is around the globe right now. We've got about 30 people in sustainability strategy advisory team. and, you know, really stepping up and making yourself the go-to team member is just so valuable. Networking, I think that's a big one as well. It's really important, especially in sustainability, that you have a large network, because Credit Suisse, for instance, right now, when it comes to sustainability, it's not just about our group, it's about embedding sustainability broadly and deeply throughout the entire organization. Seek opportunities outside your day-to-day job. I think that's really important too, in terms of contributing where you can, be it on diversity, inclusion, helping others, learning about how, you know, the different divisions work. That's a critical thing as well. You know, communicating where you would like your career to go is also really valuable, and just thinking about it on a day-to-day. You know, I think she put in some derailers in here as well. You know, positive attitude goes a long way, and, you know, a negative attitude always can impact others. And please always, you know, think of yourselves as role models. Be confident. Confidence breeds success. A lot of people I know I see do have unnecessary self-doubt, and I think, you know, you really need to not be so hard on yourself sometimes, and think about, you know, the successes that you have had. And likewise, don't be afraid to ask for more responsibility, and don't let a setback paralyze you, or, for instance, being called to present last minute. You know, when things do go wrong, I think it's also really important to not burn bridges, because the network that you make at the office will always be important to you, and you need to communicate and deal with any setbacks that you may have. I think the final one she has here is never moving outside your comfort zone, and don't be shy to take calculated risks. I don't know if we're doing Q&A at the end, but I might come back to that. Let me see what's on the next page. Sustainable investing. I'm just so proud to be part of the sustainable investing activities at Credit Suisse. You know, the generations such as you have really embedded purpose in the way that you're investing, and we see that. And what ESG investing is, can I just see, sorry, Monica, can I just see the next slides? I just want to know what I'm dealing with here. And the next one, I just want to see what's in the deck. Great, thank you. Okay, thank you. So you can just go back to the previous page. I just wanted to see what was in here. So just defining what ESG is, I'm assuming that you have some base knowledge. You know, we define ESG along a spectrum, from simple exclusions, where a client or an entity may come to us and say, you know, I don't want to invest in tobacco, so please exclude that, to more ESG integration, which is really making investment decisions along ESG criteria and truly embedding considerations, be it environmental, social, or governance, in your investing decisions. Along that spectrum, we also look at thematic investing. And then thematics could be anything from environmental funds to trying to reduce carbon footprints, to social funds trying to really empower minority groups. And then we also look at impact investing, which is having deep intentionality to the investments that we make, and that's often in the private markets. Sustainable investing at Credit Suisse right now is more than just our group. It's really taking a look at ESG factors, be it investing, financing, everything that we're doing now, we're trying to bring that into the equation. Next page. Great. Global sustainable investing is just taking off at tremendous growth rate. You can see, between 2014, 2016, the market went from 18 to 22 trillion, but now, just 4 years later, it's practically doubled. The growth rate is astonishing, but there's a reason for that. It's not just that people are waking up to the fact that sustainable investing is purposeful, but also it's proving to be good investing, and there has been alpha generation from a sustainable investing versus the non-ESG benchmarks. Similarly, global impact investing has just skyrocketed. You can see that on the bottom left. People used to believe that you couldn't invest with impact and receive market rate returns, and we have certainly shown that those two things are not mutually exclusive. And we're working to build many opportunities for true impact, be it again on the environmental side or the social side, for instance, with respect to education. And sustainable debt issuance are just taking off as well, be it green bonds, social bonds, sustainability linked bonds, which is really a new phenomena. Setting specific targets along ESG factors, whereas a company can receive a reduction in the interest rates that they're paying if they meet certain targets, is really a very recent financial instrument phenomena that's really been taking off. And then on the next page, this is the spectrum. Well, look, I think on the previous page we said 3 out of 4 companies, recently 3 out of 4 of the sustainable equity funds have really outperformed their comparable fund categories in 2020. This COVID environment has really, I think, driven this home that ESG investing has outperformed and really has shown that looking and analyzing best of class companies along ESG categories is truly good investing. And then, sorry, I don't know how much time I have, so please someone signal me. We talked about the spectrum. The Credit Suisse likes to speak about our fabulous super trends, which are really long-term trends in the marketplace where we find that there'll be alpha creation. For instance, for those of you in this room, millennial values. Also, technology at the service of humans, climate change, the silver economy, which is aging. And we very much also believe that these long-term trends, investing trends that will provide alpha generation, are very much tied to the UN Sustainable Development Goals. We have seen the buying power, the investing power that millennials have had, across a big spectrum of, UN SDGs, be it education, be it your consumer buying patterns in terms of alternative foods, or, looking at the labels of where your clothes are made and caring about, if your clothes are recycled and where they come from and what the materials are made from, the supply chains behind that. And that is really just driving investments and really just making a tremendous difference on the world. And then is there more in here? Every page is a surprise for me to go back. Just trying to see what's here. A lot of these themes that you see on the left are really starting to drive investment opportunities. Alternative food is just an amazing one. I mean, not just the Beyond Meats of the world, but also all the lab-based meats, the lab-based fish that are coming out. And I think there's been a real awakening of biodiversity and the considerations that come along with that. Every time you make an investment, you can really think about what that is doing to our environment and specifically to biodiversity. I invite you, for those of you who are interested in the topic, to look at a paper that we did with Responsible Investor to show that it's just really, everyone knows it's critical to think about biodiversity in your investment decisions, but it's hard. People don't know how to. And until we're able to communicate that framework that, we need to help our clients and investors figure out how to have such considerations in their investment decisions. Another big trend that we're also looking at right now is decarbonizing the economy and decarbonizing your portfolio and thinking about the investments that you make and the carbon footprint that those companies have. And it's also good investing because, as you think about the transitions that clients have to make, that companies have to make, you don't want to be investing in companies with a high carbon footprint because ultimately they're going to have headwinds, be it lending, be it carbon tax. And so we're looking at that as well in our portfolio decisions. I don't know if I hit on at all what I was supposed to, and I don't know if there's a Q&A. So, I welcome, I don't know if I'm supposed to pass it on to the next speaker or I welcome Q&A, and good luck in all of your journeys.
Thank you so much, Donna, for jumping in.
Thank you very much indeed. We won't have time for Q&A because I think everybody is excited to hear about the results. And I'm inviting our judge today, the godfather of the CFA Institute Research Challenge here in Switzerland, Florian Esther, to announce the results.
Yeah, I'm not sure godfather really sounds right here, but okay. Thanks, Dana. Thanks, Michaela, Monica, for these kind words. Really interesting. Thanks a lot for that. But to move on to the announcement of the winners, what we have decided is to make this a little bit more exciting. Doing this on a Zoom call is kind of dry, let me put it this way. So what we're going to try to do is we're going to reverse Zoom etiquette. What I would like you to do is to unmute yourself. I will then announce first the third place winner, and then I want everybody to shout, scream, and holler as loud as you can. And the winning team, I hope they get up, start dancing, jumping around, so we all know who it is that actually has won. Okay? Those are the rules. If I then raise my hand, so please pin my window. If I then raise my hand, that would be kind of the time to kind of come back here. All right? Everybody clear? Everybody has unmuted? Excellent. All right. Let's try how this works. Now, we'll go from third place up to first. Drum roll. So, on third place, we have Università della Svizzera Italiana. Congratulations! Excellent. Okay. Congratulations to Lugano. You did an excellent job. Second year in a row, up there in the top 3. Well done. For the rest of you guys, you can do that better, right? This was kind of, okay, it was the first one. Now we get the second place. I want a little bit more enthusiasm, particularly the guys who have won. I really want them jumping up and down. I know who you are, so please make sure you do that. Mirjana, could you do a screenshot? Thank you.
Yes.
With that, we'll come to the announcement of the second place. And the second place goes to Zurich. Now, Morten and Malte were kind of too dry there. We have to work on that one. Christoph, you have to talk to these guys, you know, a little bit more enthusiasm. And with that, we come to the winner. And please make a really loud applause for the winner of this year's team. And the winner is University of Bern.
Wow!
Excellent.
Yes.
Very well. Now, this is the enthusiasm I would have expected from Bern. Thanks, Colin. Thanks, Joel. Thanks, Rahel. Well done. Well deserved. Excellent work there. And thanks to Philip as well. And with that, I'll hand back to Mariana. Thanks a lot, guys. And everybody mute, of course, again.
Congratulations to everyone. Everyone did an excellent job. And if this was an owl of University of Zurich, we will hand out trophies to you. But we're going to send them to you to your addresses. So job well done. Congratulations. Now, before we wish everyone a lovely evening, may I please ask 3 winning teams to stay on the call and your professors as well. And to everyone else, thank you very much for participating today. Thank you to our online audience. We wish you good health and goodbye until next year. Bye-bye. So how do you feel, guys?
Overwhelmed. Feeling great. Don't know what.
Speechless at the moment.
Yeah, same. Don't really know what to say.
I'm sorry, guys. I would have liked to share a beer with you, right? I'll do it virtually, right? So congratulations. Well done to all of you.
I already had a glass of champagne, so that's okay.
So you knew where we were coming. It wasn't from me, you know.
No, that's not the case. But I knew that I'm proud of our team no matter what.
Very proud, yes, very proud. Great
Well
feeling.
done actually to all 3 teams, right? I mean, super well done, tight race, right? Good work, convincing work. We are very proud of you.
And this was one of the most contentious discussions we had with amongst the judges. Really, it was, you know, tight.
Believe that, yes.